you'd be surprised that you may be able to do business in some form or fashion wherever you're at. Maybe you're looking at an investment property. Maybe you're meeting with a broker in that place that you went to have your vacation in, and you can document that you did some business there as well. You can try to take advantage of that by good, clear documentation of what the business purpose was when you were there, and using these per diems. So that information is there. Personal tax credit summary, Exhibit 3. There are a ton of tax credits that are available out there. Again, pilot concept, checklist. Let's not miss anything. You know, a pilot, even though he knows how to start the plane, he's done it 1,000 times, has to go through the pilot checklist to start the plane every time. Same thing with taxes. Go through this checklist. You've got all these different tax credits. I mean, just look at it. An additional child tax credit, an adoption credit, child independent care credits, earned income credits, tons of these education credits. I have a separate chart on that. Point being is there's a lot of them in there, and don't miss it. By the way, one of them that is often overlooked is if you happen to get trapped in alternative minimum taxes, you get a tax credit whenever you eventually get back to paying regular taxes. I've seen this missed by a number of people that in the later years prepare their tax return. They're no longer in alternative minimum tax, but in the previous years they had paid alternative minimum tax. You get to carry forward that alternative minimum tax that you paid to eventually offset your regular taxes when you're back into regular taxes, to bring that regular tax dollar amount back down to right at the amount where we're bringing you back into alternative minimum tax again. That is not clear on what I'm saying, but what I'm trying to say is if you ever pay alternative minimum taxes, that number carries forward and can reduce your regular taxes in the future. So that's another credit that's available. I just talked about investment travel, which is often overlooked. Management or conservation of investments is deductible. So I put that language in there because it really can make you start thinking creative, including trips to brokers or financial advisors, not seminars or conventions, but actual people you're visiting for advice or looking at going to properties with. If you are in real estate investment and you are out there looking around for investment property, gosh, all those things are deductible. It's all about documentation in an IRS audit. It really is. They are going to require. They're not just going to take your word that you went and drove 600 miles last week to look at stuff. What was your beginning odometer reading? Your ending odometer reading? What properties did you look at? Why did you look at them? Again, I'm just using properties as an example. If you have good documentation, the IRS is that's key. They're gonna know it's real. Divorce-related fees. Not all of them are deductible, but if you are unfortunate to be going through a divorce, it is important to have your lawyer itemize the bill carefully, because the portion of consultation that's related to tax advice is deductible. It says the recipient of an alimony award can deduct the portion of fees allocable to the alimony. So when they make those divorce decrees, a portion of that consultation is how much is alimony versus how much is child support, etc. The more you can allocate towards that basket of alimony or tax advice is the more of that expense that's deductible. Hopefully nobody is that's not applicable, but sometimes it is. Business use of the home. I like it and I hate it. I like it and I hate it one. Here's the thing. Be careful. It is a big time IRS audit trigger. So it can get you audited. But being fearful of being audited doesn't mean that you don't have a valid deduction. So that's what I mean by I hate it and I like it. Just because it does definitely escalate you on the IRS's target of being audited, if it truly meets the use test, then deduct away. So you have to use a place in your business regularly and exclusive for business, and a place to meet with clients in the normal course of business. And then you can set up a home office, and you can allocate expenses for your home as a deduction. If you have a small office in your home, an allocation method is basically by square footage. If it's 100 square feet of a 1,000 square foot home, 10% of everything related to the expenses of your home can be allocated to that business use of home deduction. Your utility bills, your phone bills, your electric bills, your interest and taxes and so forth and so on. So keep it in mind, it is available as a deduction, but it's got to be real and used and documented and all that kind of stuff, and it can escalate you on the IRS's radar. Independent contractor versus employee. I put this one in there a lot. It's more for small business owners. Some of you may be, so I'll throw it out there because I am leery of this one. This is a severe tax penalty if you mess up. That's why I put this one on there. It's not a tax savings, it's a tax avoidance one. If you have somebody out there that you are using in your small business regularly and you basically have control over them and you tell them what to do and so forth, they're an employee and not an independent contractor. And if you don't treat them as such, you're subject to 100% tax penalty, even if they eventually collect the taxes from that employee that you treated as an independent contractor. Even if they collect the taxes from that person, they catch up with them, doesn't relieve you. They get double. They get double the taxes. That's in the income tax code. So it's a very severe one. Don't be too imaginative in that one. It's a pain, but if you have a small business and they're an employee, treat them as an employee. Set up a payroll, do the W-2s, and be careful of that one. Cancellation of debt income is becoming a big one because of all the foreclosures. So if you had debt forgiven by a bank that you're personally liable on, that is includable in income, and they're going to send you a 1099 on that. But for 2007 through 12, the cancellation of qualified principal resident indebtedness can be excluded from income. There's something to know about there. Health savings account.